In my previous videos, I was talking about what is social security benefit, how social security benefits work, and more importantly, what is meant by early retirement age, full retirement age, and delayed retirement credit. Well, in this video, we are going to talk about the financial side of it, meaning what is provisional income and how provisional income can impact retirees. And what is meant by IRS set threshold of social security benefits. And what is meant by three bucket strategy, taxable, tax defer, and tax advantages. And how this three bucket strategy can impact your social security benefits. Hey there, welcome back. Let's look at two friends, Mr. John and Mr. Peter. Both of them worked hard, saved diligently, but they chose different strategies. Let's begin with Mr. John, who is a traditional retirement planner. Little background about Mr. John. Mr. John retired at the age 65. At the age 65, Mr. John's portfolio looks something like this. He had roughly 1 million in his traditional 401k. Mr. John has another 50k in the bank account as an emergency fund. If you don't know what is emergency fund, would you agree with me that life is unpredictable? You may face unexpected medical expenses, even health challenges. If any of that uncertainty happens, are you good enough to pay your bills? Which is called the emergency fund. And number three, Mr. John is qualified to receive social security benefits as 30k annually. And number four, Mr. John also has another 50 to 60k in the stock market. So this is how Mr. John's portfolio looks like. Now what is Mr. John's objective? Mr. John wants to have a better retirement life. In order to have a better retirement life, you may need roughly 50k annually. And before we go much deeper into it, let's talk about what is provisional income and how the provisional income is being calculated. Provisional income is typically the IRS way of figuring out how much of your social security benefits may be taxable. The formula goes something like this. Your adjusted gross income plus non-taxable interest like municipal bonds interest and 50% of your social security benefits. Now let's calculate the provisional income for Mr. John. The 50% of social security benefits is 15k. Plus Mr. John wants to take 35k from his traditional 401k. And as I mentioned earlier, Mr. John has roughly 50k in his bank account. He is earning $500 annually as an interest. As per this breakdown, Mr. John's total provisional income is $50,500 annually. Here is where things get interesting. Let's see the IRS set threshold of social security benefits. It depends on the filing status. If the filing status is single, then this is how the provisional income and the social security benefits taxed. And number two, if you are married and filing jointly, then this is how the provisional income threshold looks like. To understand this further, let's assume Mr. John's filing status is married filing jointly. Let's look at the threshold. What it tells us is, if your provisional income is below 32k, then 0% of your social security benefits is taxable. And the second one is, if your provisional income is between 32 to 44k, then up to 50% of your social security benefits is taxable. And lastly, if your provisional income is above 44k, in our scenario, Mr. John's total provisional income is $50,500. Then he falls into the third category of above 44k, meaning up to 85% of social security benefits can be taxable. Let me make it more clear for you what is meant by 85% of social security benefits can be taxable. Well, it means 85% of your social security benefits can be counted as a taxable income. For example, in order to calculate the total taxable income for Mr. John, let's look at his portfolio. Here Mr. John is accessing or withdrawing 35K every year from his traditional 401k. Let's add that to the total taxable income plus $500 interest that he earns from the bank annually. And number 3, the social security benefits. As I mentioned earlier, Mr. John is qualified to receive the social security benefits as a 30K annually. However, based on his provisional income, Mr. John falls into the 85% of social security benefits taxable. The math goes something like this. 85% into 30K, he ended up with 25,500. That 25,500 adds to the total taxable income. Now, the total taxable income for Mr. John is 61K. And you know how the marginal interest rate works. Based on the 61K, Mr. John wants to pay the income tax. Now it's time for us to understand what we can learn from Mr. John's strategy. Well, let me simplify this. Majority of the people retire with most of their money in the traditional 401k or traditional IRA. The problem is, every time you take money out of your traditional 401k or IRA, you must pay tax. In addition to that, that money adds to your provisional income, which eventually triggers taxes in your social security benefits. To say it in other words, the same withdrawal that you do, it creates multiple taxes. One is the retirement tax from your 401k. Number 2, your social security benefit tax. Now you might be wondering how to get rid of this. Well, let's look at Mr. Peter's strategy, who is a diversified retirement planner. Same like Mr. John, Mr. Peter also retired at age 65. Now let's look at Mr. Peter's portfolio. Number 1, Mr. Peter has roughly 300K in his traditional 401k. He has another 400K in the Roth IRA. He also has 300K in the cash value life insurance. He is also qualified to receive the same 30K from social security benefits. And number 5, he has 50K in the bank account as an emergency fund. Mr. Peter's goal is to have 50K to have a better retirement life. Now, let's calculate the provisional income. Mr. Peter wants to take 10K from his traditional 401k. Let's add that to the provisional income. Now, here is the kicker. Mr. John wants to take 15K from his Roth IRA and another 10K cash value life insurance. Now, the beauty is, whatever money that he takes from these two strategies don't count in the provisional income as per IRS rule. The $500 interest that he earns from the bank and 50% of his social security benefits is 15K. Now, if you do the math, total provisional income is $25,500. Now, let's look at the IRS set threshold for Mr. Peter. Mr. Peter does the same as married filing jointly, and his total provisional income is $25,500. If you look at this threshold, Mr. Peter's income is below 32K, meaning 0% of social security benefits is taxable. If that's clear to you, let's do the math for the total taxable income. Mr. Peter's total taxable income, 10K from the traditional 401k, $500 from the interest that he earned from the bank. Now, here is the kicker. His social security benefits is 100% tax-free because his provisional income is $25,500, which is below 32K threshold, meaning his social security benefits is tax-free. Number 2, the 15K that he withdraws from the Roth IRA is also tax-free. On top of it, the 10K that he withdraws from the cash value life insurance is also tax-free. Let me summarize this. We looked at two friends. One is Mr. John, other one is Mr. Peter. Both of them worked hard, saved diligently, but chose different strategies. To say it in other words, there are only two kinds of people out there. One is the informed people, the other one is the uninformed. If you look at our two friends, Mr. John and Mr. Peter, Mr. John falls into the category of the uninformed because he just followed the traditional retirement planner strategy and ended up paying more in taxes. On the flip side, Mr. Peter falls into the informed strategy because he followed the diversified retirement planner strategy, where he ended up paying less in taxes, was able to keep more in his pocket. Now, my question to you is, which strategy do you like the most? Mr. John's strategy or Mr. Peter's strategy? Please drop that in the comments. We'll see you there in another video a week from now. Until then, I am Prakash, signing off.